Fewer new homes were built in the last decade than in the 70s or 80s. Can you say inventory problem? Home equity continues to surge, so are cash out refinances getting out of hand like in 2006? Rates are likely to continue to rise for the rest of the year. What does that mean for the market? That's what we're going to cover in this monthly market report. This is for you if you're a real estate agent or a financial advisor interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here's the market data you need to make an informed buying or selling decision, or help your client do the same. So the story of this month is that we're seeing a rise in interest rates. The average 30-year fixed, as recorded by Freddie Mac, is at 3.18%. And to put that into perspective, last year we saw rates in the mid-2s. This puts us back somewhere around where we were in June of last year, before we saw the rate environment start to slide down. But despite the uptick in rates, I agree with the chief economist at Realtor.com. And he said this: home sellers and home buyers have gotten really used to extremely low rates. Rates even in the 3% to 3.4% range will remain extremely affordable by historic standards. Now, I do expect in the coming month that we will get estimates and forecasts for what experts believe rates are going to do from here on out, and I think some of those are going to be revised up. We've already seen Goldman Sachs saying rates could be as high as 3.75% by the end of the year, although some forecasters are saying lower. While there is no way to know for certain, we should expect rates to rise a bit more through the rest of the year. The inventory challenge across the country stubbornly persists. This is a snapshot of new listings coming into the market as compared to the total listings in the country. Right now, on average, we're down about 52% year over year in the number of homes that are available on the market. Now, if you look at the green line, however, that could be a silver lining if it continues to trend up. But to illustrate just how dire the situation is, look at this map. We can see the majority of the country is in red. Some states in the dark red are down over 60% year over year in terms of inventory. While this shortage should alleviate in the second half of the year, as we stand right now, the inventory situation across the country is pretty dramatic in terms of lack of available homes for sale. The Federal Housing Finance Authority said this: house prices nationwide recorded the largest annual and quarterly increase in the history of the FHFA Home Price Index. Low mortgage rates, pent-up demand from home buyers, and a limited housing supply propelled every region of the country to experience faster growth in 2020 compared to a year ago, despite the pandemic. No doubt this lack of inventory we have today has been caused by a number of different factors, such as the pandemic and low interest rates, but you probably didn't know the one I'm about to share with you right now. And this is very interesting, and I encourage you to share it and get the message out there. Here is the data reflecting new single-family units completed since 1970. The dotted line is the 50-year average, and as you can see, for the last 13 years, the bars in green reflect that we have not only remained below the 50-year average, but that we have built fewer homes last decade than were built in the 70s or 80s. In other words, housing supply has not proportionally accompanied population growth. This is mind-boggling. Of course we have an inventory problem. How could we not? Builders have not been bringing to market the number of units to keep up with population growth. Now, with that said, building permits are up right now, so let's see if they can bring some much needed inventory to market. Last month I asked if this is not 2008 all over again, is it 2006 all over again? One of the questions that's been coming up lately is, are we seeing a cash out refinance issue? Here are a couple of clipped headlines, for example. Cash out refi surged to their highest level since the financial crisis. House or ATM? Cash out refinances spike in 2020. And that leads us to the question, are we seeing a cash out refinance crisis in this country? Here are the facts to be able to go out and educate the clients that we serve. Firstly, let's look at home equity cashed out by refinances in billions. $153 billion of equity were cashed out last year, but that pales to the $321 billion cashed out in 2006. What this implies is that the amount of tappable equity that US mortgage holders have has surged. Tappable equity is defined as the amount of available equity for a homeowner to access before hitting a maximum of 80% loan to value ratio. So if you own a $500,000 home and you owe a mortgage of $400,000 on it, that's 80% loan to value. And what I'm saying is that equity in homes is surging right now due to the way that folks have handled their equity over the last 10 years and have not accessed it. Back in 2006, tappable equity was at $5 trillion, and where it stands today is over $7 trillion. As we look further into this, cash out refinances in 2020 were nothing like 2006. Take a look at this chart with 2006 in red and 2020 in blue. In 2006, there was $4.6 trillion in tappable equity in homes across the country, whereas today we're at $7.3 trillion. Back in 2006, 89% of refinance transactions were cash out refinances, yet last year were only 33%. The total cashed out was $321 billion in 06, $153 billion in 2020, representing 7% of the tappable equity back then, whereas today it's only 2%. So very, very different today versus back then. And what are people doing with that equity? Are they misusing it like the lead up to the housing crisis? Absolutely not. The Wall Street Journal said this: the residential real estate market is on its biggest tear since 2006, just before the housing bubble burst and set off a global recession. Yet in nearly every meaningful way, today's market is in the inverse of the previous boom. In the mid-2000s, loose mortgage lending standards enabled borrowers with poor credit histories to purchase homes beyond their means, sometimes with mortgages that required low payments in the early years of the loan. And they go on to talk about how that froze up the credit markets across the country. Well, we know that today lending standards have changed. We know that in order to obtain financing for a home loan, you've got to demonstrate the ability to repay. Today is very, very different, not only in terms of lending standards, but also in terms of inventory. The National Association of Realtors said this: with demand for homes outpacing new listings, buyer competition continues to intensify. On average, there were 4 offers per sold home in February, according to NAR's latest February Realtor Confidence Index report, a monthly survey of realtors about their transactions. 1 year ago, there were 2 to 3 buyers for every home sold. The intense competition has led to double-digit price growth and properties selling in record time. To get back to a healthy supply equivalent of 6 months of monthly demand, an additional 2.7 million homes should be on the market for sale. If you look at this graphically, 4.1 offers in February is dramatically higher than where it's been for the last several years. And that's also what's leading people to ask the question, is this like last time? It feels hot like 2006. So let's break down the comparison of the two markets. As it pertains to appreciation, look at the time leading up to 2006 and compare it to today so that we can educate our clients on the differences in the two markets. I spoke about this last month. Firstly, if you look at annual home price appreciation, 2020, according to CoreLogic, saw 9.2% appreciation. But if we compare the years surrounding the lead up to 2006 to the years in the lead up to today, prior to the crash, the average annual appreciation was over 10%. That's just the average from 2002 to 2005. And today, 2017 through 19, the average is only 6.3% annual appreciation. That's a big difference. And let's not lose sight of the fact that prior to the crash, home value appreciation was led by speculation, whereas today, it's based on need. Take a look at this graphic, which shows default risk in the mortgage markets. This is a very good visual to talk about where we are with regards to lending standards today as compared to back then. Look how there is no red in the present day. Red depicts how risky mortgage products were back then. And you can clearly see how that might have led to speculation. Today's regulatory environment prohibits those risky mortgage products from existing. Moreover, borrower risk has been severely cut back as to where it was back then as well. It's more difficult, in other words, to qualify for a home loan today. When we look at demand, we can say back then demand was inflated by speculation, whereas today demand is real as measured by those in their ability to qualify for a home loan. Here is yet another interesting comparison. Back then, single-family inventory was rising from 04 through 07, yet prices were going up simultaneously, whereas today inventory has been going down, and as a result, prices are going up. It's common sense, or economics 101 if you will, that the fewer items of something there are for sale, the higher the price is likely to be. So how could it be that in 2006, as the number of items in the market were rising, in other words, homes for sale, the prices were also rising? That doesn't make any sense, unless, of course, there is a whole lot of real estate speculation going on, and that's exactly what happened. The reason for the price growth today has been in large part by extreme demand for some very real reasons: low interest rates, the pandemic, and the lack of available homes for sale. This is an increasingly competitive home buying environment, and that's true across the country. So what does this mean for current homeowners? Well, their home equity has skyrocketed. The average gain in equity on a mortgaged home over the last year has been $26,300. The current average equity of a mortgaged home is a whopping $204,000. 38.2% of homes across the country are owned free and clear, and equity increased 16.2%, totaling over $1.5 trillion. So equity is surging across the country, and as we go throughout the rest of the year, we should educate our clients in helping people understand just how much equity they have in their home. They may just want to do something like trade up. Many may not know that they have that much equity in their home. That's a wrap for the April monthly market report. I appreciate you listening in. Forward, subscribe, or share. I'll be back next month, but before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.